Hi, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. We're going to make this one a quick one because it was mainly a market of calm after the rebound from last week's market shock. And what we had basically was the administration, or I should say Trump specifically, threatened huge tariffs on Europe, and the market had a shock. And then soon after that, Trump changed his mind, and we had a big update Monday. But neither buyers could push higher and sellers couldn't push lower when prices drifted down. And I'll show in a second, of course, the technical implications of all that. So let's timestamp this. This is May 30th after the market close, actually well after the market close. Here's some of the big headlines. Elon Musk has left or leaving Doge. Um, there's a bunch of stuff here, as you can see. Let's see, trade stuff, legal stuff. But what I don't see right here is inflation. The Fed's favorite read came in very mild, so that was good news. We had some more trade action. I mean, we basically can't get through a week without some sort of trade headlines. And actually, I thought until last week's temporary market shock, I thought the market was pretty much in a place to ignore trade news. Now maybe we are back to that point, particularly with this new acronym called TACO that Wall Street is playing on. And if you don't know TACO, just look it up on the internet. I won't go into it here. All right, so let's go ahead and jump into the technicals. First of all, market breadth, my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50. You can see here on Monday, and this is a trade shortened week. So we only had 4 trading days. Market breadth jumped right off of this nice support represented by the 20-day moving average. And then we made no more progress for the rest of the week. And in fact, Friday, there was this pullback, I think related to more trade drama on NVIDIA. And but then the buyers finished strong and we ended up back in the range. So anyway, as I mentioned in another video before, typically I would consider the market in a bearish position given reject these rejections from the overbought threshold, but the market is well supported. So I am staying cautiously bullish. And what do I mean by well supported? Well, let's take a look at the S&P 500, for instance. The S&P 500, when we had the market shock, it dropped right perfectly to this 200-day moving average support, which is the blue line. And this big purple line here is where the market closed right on election day. So I call this the pre-election close. And then this other thinner purple line is where the market closed after the election. So you can see how important this range has become. And in the recent 2.5 weeks or so, the S&P 500 has basically been trapped in here from, continuing to celebrate this oversold bounce to pulling back on various news, including the market shock with the big tariff warnings and now the rebound, but it failed to get above this. So, you could try to be cute and play these ranges. I was successful in playing this test. And, I didn't know that Trump was going to turn around and taco on us right away. But I just played the technicals and sure enough, it worked out. I did not do anything like get cute and try to play puts off of here because I am cautiously bullish. So the bigger story here for me is that if it does break out above this line, which is currently at 59.32, I think the S&P 500 will be clear to test and maybe even break through to test the all-time highs and maybe break above that. And if it breaks down below, I'll turn neutral on the market. So below means below 57.88 or so. I'll turn neutral. But I won't get bearish until or unless the S&P 500 breaks below its 50-day moving average, which is this red line. Because if it does that, then unfortunately the April lows will be back into play, or maybe this higher low will be back into play for sure if that breakdown happens. But one day at a time. And remember, I offer this information for educational purposes. Please trade and invest on your own risk tolerances and time horizon. Also, please like and share this content so the algorithm knows what's up. You can hit subscribe, hit the notification button so you can get alerted when new content drops on YouTube. And of course, please do put any comments or feedback down below. And you can always check out my blog at drduru.com/122, all letters, for more details. Okay, so the NASDAQ, same story as the S&P 500, jumped up. It actually broke out above its previous high, but then got faded. Now that's bearish, but again, you'd only short this or get puts if you're trying to get really cute. I'm not trying to get cute here. I just want to see resolution, either to the upside or the downside. And then IWM, the ETF of small caps, its story is that it broke below temporarily its 20-day moving average support. It just barely rallied back after that market shock a week ago. Then it popped on Monday. What was this? 2.5%. And it drifted lower and held this 20-day moving average support. Typically, I would have bought some call options for play, hoping to bounce over the weekend, but my last play didn't really work out, and I have a bad feeling that IWM is going to hit this 50-day moving average around 197.68 before it bounces again or challenges its 200-day moving average. Earlier, you see this uptrend line. I was thinking it was going to go straight up for a test of that. So I'm a little disappointed and a little bit more wary about small caps. Now let's take a look at the VIX. The VIX, of course, with the market shock, soared all the way up to, let's say, almost 26. I totally missed the opportunity to fade that. There was every reason to fade this. The VIX rallied right to its previous high point. Since I went long on the S&P 500 call spread, I should have juiced up those returns with a fade volatility as well, but I did not. I will be on alert next time. Pay attention to this line now. This is exactly, look at that, how perfectly that support held for the VIX when we, in preparation for rallying into this market shock. So as the VIX drifts down again, we will be looking to see very carefully whether this support holds, and we have to get a little bit more cautious until the VIX breaks down below that for its next test of the lows of the year. All right, let's jump into some individual stocks that caught my eye. Of course, NVIDIA was the big story this week. It had a very bearish reversal of earnings. It popped. It popped up. It gapped up higher on earnings, and then it closed for 3.25% gain. Now, I went ahead and bought a call spread. I like to do the calendar call spread. I like to do those in these situations when I think that people are overplaying the calls that expire the next day, DT1 or DT0 options, however you want to call it. And then I can use that short side to help pay for the long side, which is going to expire next week. But given this full reversal of NVIDIA, my trade pretty much blew up today. And why did it reverse again? I didn't see it on the headlines, but it was again the threats about restricting NVIDIA exports to China, I believe, was the headline. Now, the other implication to this, why I say this is a little bit more bearish, is because ever since this double bearish engulfing top in NVIDIA earlier this year, I've been claiming that NVIDIA was going to trade under this level for months. In fact, much longer than it traded under previous topping patterns. And that's exactly what has happened. And this fade means that, I don't know, maybe NVIDIA continues to trade under this topping pattern for another several months. But overall, it's still bullish because it's above the 200-day moving average and also above the 50-day moving average. So it too, like the market, is well supported. So I'm not bearish on NVIDIA per se. I just don't think it's going to pop. It's going to challenge this popping action anytime soon now. All right, so that was the really big story of the week. Let's go to another AI related play. This is one I posted a short about because it broke out above the 200-day moving average. It was one of my best bullish calls at the time. We're still in the middle of this rally off of the trauma of the tariff trauma and drama and noise from March and April. And it worked out really well. Now I'm a little nervous. Earnings are coming up next week. I doubt I'm going to hold my shares into earnings. So I just don't want to risk reversing or losing all of these gains that I had here. And, if it turns out to be a positive earnings, I'm not going to cry about it. It's all about risk management at this point. So this is Credo Technology Group Holding Limited, ticker symbol CRDO. Now, my favorite AI play is Vertiv Holdings, ticker symbol VRT. You can see it's in bullish position, trading very nicely above its 200-day moving average, which is currently at 102.46. It broke out here, didn't make much more progress after that, but then on its drift downward, it tested that support and it held. And I'm looking to add to my position here. So this is one of my favorite AI plays. They sell components into data centers to support AI build outs. So that's a really popular and important area right now. Now, Apple's another big one. It got slammed by that big tariff shock, and I think this iPhone tariff threat is actually still in place. So I'm surprised that Apple was able to bounce so readily. But notice that it did fail its resistance at the 20-day moving average and 50-day moving average. So that means Apple's still bearish, and I'm still going to stay in my bearish position on Apple, which is the inverse 1X bear ETF, ticker symbol AAPD. And I'm going to stay in that until Apple breaks out above this or until it comes. Well, I don't know. It kind of seems kind of realistic that it'll test all the way to down to these April lows, but um, I'm not definitely, but I'm looking to take profits if it, gets maybe halfway between where it is now and those lows. All right, let's take a look at retail or yeah, retail. Best Buy had bad earnings reaction. Not no surprise there. Who's buying electronics right now? No, after the big rush to get ahead of tariffs, I think people got their fill of electronics for this point. I didn't have time to read through the earnings, but the technicals say that this was a very bearish breakdown. We essentially got confirmation of that breakdown with today's selling follow through. So, and this is bearish because Best Buy is below the 50-day moving average. Again, it's this red line here. I don't know. I'll see how things go next week, whether I'm going to fade this one and get short. I'm a little hesitant to do that because Best Buy was good to me when I sold the put against the stock down here towards the lows on a bet that on a bet on oversold conditions. So I am grateful for that, and I feel like I'd be turning 180 on the stock by now going bearish. But this is not about feelings. It's all about business. So let's go to a retail related stock that's actually doing the reverse, which is it. I thought it had confirmed this topping action when it suffered 14.8% post earnings loss. So kudos to you all who's hung in there. I mean, and hanging in there means that people have had some really great gains after this stock, even way back in 2022 bottomed. Just incredible. It's like everybody is eating at Olive Garden or something. This is Brinker International, ticker symbol EAT. And, the sellers were able to follow through and even crack to some new lows here, new lower closes, but the stock is just steadily recovered. And I totally missed this nice bullish pattern here, which was first the breakout above 50-day moving average, a drift into support at the 50-day moving average. Again, it's the red line. And look at how perfectly, let me zoom in here, how perfectly it held that 20-day moving average support, which is the dotted line, and it's been up ever since. So now it's even more bullish because it broke out above previous highs. I'm looking to buy this. I'm going to scale into it very slowly, but this is a totally bullish breakout. Again, we'll see how things are going next week, but I would love to buy it on a pullback to around 163, 164, which should be support at the previous high. Now, on quantum computing side, this is my favorite quantum computing stock, IonQ, ticker symbol IONQ. I was really regretting having missed this big surge. It was 36.5%. Unfortunately, I forget the news now. But it is pulling back right below all-time highs, so that's a little bit bearish. But this support here, the 20-day moving average, the dotted line, it held out pretty well. So I am going to start buying it again on a test of that support, and I don't mind buying some more on a test of 50-day moving average support and 200-day moving average support. But we'll see what happens. That's again, I take this stuff one step at a time. And then FICO is another one of these hard, just these unfortunate, hard, less technical lessons. As I wrote about in my blog, I totally missed this warning to go ahead and take my remaining profits when FICO first fell down 8%. And then I only noticed that it was weakening when it fell almost 16% the next day. And then I said that I was just going to take my losses if it continued to sell. And sure enough, it did. It opened the week on Tuesday with another 11.3% loss. So I sold when it broke down below this low. And now you can see it's in recovery mode. Now, I think this recovery is justified because all this deep selling just based on I think it's the FHFA director's displeasure at FICO's pricing. All this selling seems very overdone, but I respect the technicals. But now I've scaled right back into a position. Of course, I regret having to take that loss, and I will take a loss again if it breaks down below this low. But I am happy to be back in the stock. And the reason why I was a little wary is because look at all of this huge uprun that FICO has had. And it's of course survived a few big dips, but since the lows in 2022, it has been pretty much nonstop. So to see it break down below a low was warning me that maybe something has totally changed. And of course, being below both the 200-day moving average and the 50-day moving average, just bearish technicals regardless. So that's the story there. One more, which is Uber. And Uber fell based on what seems to me the same old robotaxi news. We all know robotaxis are coming. We all know that Tesla is dedicated to it. Not sure why Uber is selling yet again on robotaxi news, but I'm going to take this as a buying opportunity. I wrote about Uber before, how skeptical I've been so long, and now that it broke out into all-time highs in early May, it's definitely in bullish territory. So I'm welcoming this pullback as a buying opportunity. All right, so that's all for this week. Again, it seems like the market calm is back. Let me put up the S&P 500. The market calm means that the S&P 500 stays between this range of the pre-election close and the post-election close. We'll see what happens in this coming week. I'm just going to suspect we're going to keep bouncing through here until we get the next very strong and convincing catalyst. And I think that the taco trade is going to be in full effect with the market tending to ignore the next set of tariff noise. And remember again what I was talking about back in March and April, which is the typical market dynamic is the markets panic, then our policymakers panic, the policymakers act, and then the market celebrates. So this whole taco trade meme stuff is a way of Wall Street essentially taunting the policymakers, daring them to send the market into a panic again. So this is going to be an interesting game going on. So anyway, thanks for checking this out. Check you out the next time. Don't forget to subscribe. Take care and have a good one.